Hello guys, my name is Lukas. Today I'm going to show you how you can quickly build a financial model with the example of Agrana Beteiligungs AG. It's an Austrian fruit, starch and sugar company, and I would like to demonstrate you shortly, or rather shortly, how you can build a free case DCF model, and also we'll show you a little bit of Excel shortcuts you can apply. Here I've written down a bunch of them, but there are quite more, of course. And yeah, I would like to show you that because I think it's very important. Many people asked me how you actually can build a quick and dirty financial model. How you can build a very detailed financial model, and I think it always depends a lot on the company, of course, and of course of why you are going to do it. Yeah. So first of all, let's see. Okay, this is a Grana. This is an Austrian fruit starch sugar company, as I said before, and I evaluated this company as part of the CFA Equity Research Challenge. So hopefully, I know this company quite well. Because usually before you build a financial model, you have to gain a comprehensive understanding of the company, obviously. So you read a bunch of company presentations, the whole annual report, of course, of the last 3 years or something, and then you also read equity research reports and industry information, because a financial model is not like I downloaded all the financial statements from Thomson Reuters, and that's fine, cool, nice to have. Let's build a financial model and make our assumptions. I mean, that's not how it works. A model reflects in a very summarized way market behavior, market conditions, where your company is currently in the business cycle, and so on. Because otherwise, you can't you can't just say I got started with my financial model and do my forecast just what I think that is going to be. You have to analyze the industry, you have to analyze the company, the products, the competitors, and so on before you actually get started. So I would always recommend to do that beforehand and not when you build the model, because when you build the model already, you will find like that now that's my estimated target share price. It's bullish, very very good, based on this and this assumptions. But actually, if someone questions you why you've made this assumption, most people then answer with guesses or can't really justify what you've modeled in. So make sure that you have a good understanding of the company and the industry beforehand. But anyway, let's get started here. So we have Agrana Beteiligungs AG. Usually, what I do before, I right at the beginning, I plug in the financials of the company. So the three statements, right? The income statement, the balance sheet, cash flow statement. Then also, if the company has segments like Agrana has, you also plug in the segment information and calculate some key ratios, key indicators, multiples, and so on. Yeah. So I structured this in these four sections. That's always how I do it, because usually, as you can see, it can get very, 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 very detailed. Because most people I would like to have it very easy and download all the data necessary from Thomson Reuters or Bloomberg or whatever. But actually, that's not what I recommend if you really try to analyze a company and to understand the business model, because you will never, because you have the data ready and so on. Yeah. So I always recommend to plug in data by hand. So you go to the very straightforwardly, you go to the annual report of the company, like here, of the last three or last three, four, five annual reports, and plug in the data by hand. Yeah. So you go to the financial statements here, for example. Where is it? Notes. Financial statements. All right. This is the segment information, for example, for the three segments. Then, of course, there's also always country information. So also very important if you want to analyze where a company is operating in mainly, what are the company's core markets and so on. It's very important. That's also important. So this, for example, your balance sheet. Then we have the cash flow statement, income statement, and so you always want to plug this in by hand if you really want to analyze the company, because believe it or not, if you plug in everything by hand, you already learn something about the product. You already learn about some margins, if there were some major outliers in 1 year or not. So believe it or not, that's important. And even though it's very boring, of course, but you learn something already. Yeah, so I would really recommend to do that if you want to do it in very good detail. Yeah, and you get some data feeling. So what I did is I plugged this, as I said, everything in by hand, just in the same structure as you have it in the annual report. That's always how you do it. So income statement is straightforward, then balance sheet, of course, and cash flow statement. So plug in everything as it is on the annual report, and then you get started with formatting and stuff and so on. So here, this is segment information. Agrana has sugar segment, fruit segment, starch segment. That's everything they disclose. So what do they disclose? They disclose the total revenue, inter-segment revenue. So that's usual what they make some cross sellings within the segments, of course, sometimes to generate synergies and so on. This is the total revenue then, and they disclose EBITDA, EBIT, of course, EBIT after exceptional items. So here, for example, Agrana has some share of results of equity accounted joint ventures. So what does it mean? That means that they have joint ventures, for example, in Hungary or in China, and they have a majority equity stake in these joint ventures, and of course they also get some results then. So what we would use here is, for example, not before exceptional items, but after exceptional items, because these are equity accounted joint ventures. So they have some CapEx disclosures. That's very good. Everything by segment. So this is a fine information. Usually, many companies don't give that much information about the segments, like also assets, equity, liabilities. Mostly just state revenues, and if you're lucky, then EBITDA or EBIT. So this is a good information. Then we have segments by regions, and so on. That's also important. Some like where you have most of the PP&A is called the property, plant and equipment, PPE. Sorry. Anyway, then you calculate some margins based on your income statement, of course, to gain some understanding and so on. Okay, there happened something anyways, because I relinked them. Yeah, and I'm not going to do that now because it doesn't matter for our session here. So right, so this is important, and you always want to have this structured. So that means you can group all this stuff. So how I can group it, to show it a little bit of extra shortcuts at the beginning, you select Shift and Backspace to select a row in Excel, and then Command or Control depending on where if you have a Mac or on Windows, Microsoft, then a Windows computer, sorry, then you press Shift, Control or Command, and with the arrows downwards to select the next rows where there is a value in the cell. So here, for example, was EBITDA, the last value. And then you press Shift and Alt and to the left to ungroup, or to the right to group. Yeah, it's that simple. Right? So you can do this for whatever you want to segmentize your information. Right? That's so far so good. Okay. Then what you also do before you start modeling is to start classifying everything in terms of debt, cash, current assets, current liabilities, so working capital, maybe also trade working capital. So really start to classify everything then. So here, for example, I classified current assets and inventories as working capital. Cash and cash equivalents belongs to net debt, obviously. Borrowings, non-current or short-term, so also net debt. borrowing long-term also net debt and so on. Financial other payables maybe also net debt, but in this case we just saw that financial and other payables, we would have considered this that these have some. You have also Ukraine also has to pay interest expenses for this debt, but actually that was not the case. So you dig into the notes of the company here, like sorry, here for example, to these notes, so you can find them in the appendix, and then you just read the information and see, okay, what is actually in intangible assets, are the licenses, what is in property, plant and equipment, and so on, what is their depreciation, amortization schedules, and so on. So that's always what you're going to do and want to find out about the company. So we did this here, for example. Anyway, so I think before we start elaborating everything, we can get started. Also, small hint, when I want to have something very structured, it's always, if you have so much information, like we had here, for example, yeah? Like, okay, anyway, where is this, for example? Like here, for example. You have so much information, so many different numbers. You would like to have them aligned in a very structured, because otherwise you will, and if somebody is not really into the company, takes hours to understand what you actually did here. If you're plugging something by in the hard data, you also want to have them in the blue color, and if there is a formula involved, like here, it can be black, for example. So everybody knows now, okay, this is hard plugged, this is calculated, hard plugged, calculated, and so on and so forth. Okay. So I also filtered here already for peer group. This is a peer group of Agrana. We have the levered beta, we have market, we need this later for back. We have the multiples and so on and stuff. Then we also calculate here always the range, possible range of like the mean 25 percentile, median average 75, and so on, to have the range of values here actually. Then you can also continue with if you want to find out, okay, is this peer group now very volatile? By the way, control 1 is the shortcut for the formatting stuff here. Then you want to have like the coefficient of variance. This shows you how volatile is your peer group, how volatile are the numbers compared to the average. So you divide the average of these numbers by the MacBook, by the standard deviation. Copy this cross with Alt, Command V, and plug in formulas, because then you won't destroy the format. Okay, this doesn't matter for me. I think it's the other way around. Sorry, I don't do this usually. I think it's coefficient of variance. Yeah, it's the other way around, sorry. Standard deviation by the average. Okay, so you can see, for example, it's 35% more volatile than the average and so on and stuff. So if it's above so 100%, it's usually very volatile, not that good. Maybe you have to select some other peers as well, or multiples or bias or whatever. So you have to look at these numbers then. But anyway, we've got 9 peers, and it's our fine numbers. So then we got the VAC, and so we will here calculate the VAC. Then here I already did some calculations. I will explain later what it is about. But before, so now we can get started, and so we know what we have here as data. Now we can get started with building a DCF model. There are a bunch of valuation methodologies, like the discounted cash flow model. I will show you then. Then the multiple valuation here we can divide it into comparable company analysis, where we're going to evaluate your company based on current market data of current multiples, and apply the multiples to your, like how our competitors evaluate it, compared to and compare this then to your company, and evaluate your company based on the values of other peers. Then the same with precision transactions, but only with deal values. So what did, like, private equity firms, competitors, etc., pay for your peers, for your competitors, and you're going to evaluate it based on the deal values. Usually the precision transaction analysis, it is called. The multiples here are usually higher than the multiples you get for your peer group, for a trading peer group. But yeah, then there's also the LBO, leveraged buyout analysis. Usually you only do this if you're sure or want to consider what is my company worth for a private equity investor, and so on. But yeah, we continue here with the discounted cash flow analysis. So discounted cash flow analysis belongs to the intrinsic valuation methodologies, and it says that how much is my company worth based on the present value of future free cash flows. So why free cash flow? Because you as a shareholder, you're always interested how much cash the company produces for you, and how much cash it has available for you as a shareholder. You always want to know that. Usually many people say, I want to know the P ratio of the company and the price to book value. Actually, the P ratio is the most biased multiple, and you're never going to use this just as additional information. You're going to calculate this, and the price to book value, you're only going to use this for FIC, so insurance and banks, because they have no EBITDA and so on. So you value them based on the book value of the companies, because because banks have a huge balance sheet, so you value the balance sheet of the company, so book value. So here we use DCF for Grana because it has strong cash flows and it is a rather mature company. When I always start modeling, I try to make some sections to keep everything organized at the beginning and have a good overview, because if it's getting into a lot of detail, it will get messy. So here, for example, I say, okay, this is my discounted cash flow analysis. Let's do something like this. Discounted cash flow analysis. Alright, so as I said before, it's a present value of predicted free cash flow that the company is worth. So I always start with the last 5 years, we have 2018, last 5 years. You can also start with last 3 years or something, depending on how much information you get and how much detail you want to have it. For example, if it's a company that has a very stable free cash flows, you can use only 3 years or something in the past, because you always look into the past as well to see how they have performed and determine in which business cycle the company currently operates in. But anyway, so we predicted into the next 5 years. So we're currently in 2018. Usually you will also have here, for example, the last 12 months data as comparison, but I don't have it here now, but usually you can do it as well. Then let's format this quickly. Okay. MacBook's always different. So this is, for example, my forecast period here. This is my historical data. So then you want to calculate free cash flow, right? So we have to remember, okay, again, how do I get to the free cash flow? So you just write this down. I always begin with modeling to write down the bridge to my free cash flow. So revenue, cost of goods sold, equals my gross profit, then gross profit minus SG&A or other operating expenses, so like R&D or whatever, other operating expenses, and other operating income. Then we got my EBITDA, then minus D&A is my EBIT. Oops. Then minus taxes is my earnings before taxes. So we actually want to calculate the unlevered free cash flow, meaning that we don't account for interest, expenses, and income here. Usually, because you want to validate the company based on what is my company worth for both debt and equity holders. So you don't subtract interest rates here, interest expenses or income, or add income, because then it would be the levered free cash flow, and you have to use a different discount rate and so on. But here, let's keep it like that. Then this is your EBIT. So right, this is actually only your income statement without the financial result, and then you add back everything that is not cash, like we haven't, because D&A is not a non-cash expense. So you want to have the cash of your company. So you add back everything where you have previously subtracted non-cash expenses. You add back the non-cash expenses again. So D&A is, for example, non-cash expense. Provisions would be also non-cash expense. D&A then minus the working capital. Call this net working capital minus capex. And so change in net working capital. Why change? I will explain you later. Then capex, and then you have your unlevered free cash flow, right? So this if you don't remember this, while modeling, always do this at the beginning, and then it is structured, I think. Here you can also say like this is less. So this is also this is plus. So you know what you did. This is less, and this is plus. Yeah. Okay. So right, let's see if this actually fits what our company is giving us. Okay, right. So there is no real cost of goods sold. Maybe cost of materials. But this is a very heavy working capital and company, because you have lots of, it's a food processing company, so they have lots of materials and resources they have to buy on the markets from farmers, and they refine this stuff. So they have lots of different change in inventories of finished and unfinished goods, own work capitalized, and so on. Lots of things that can be considered as cost of goods sold, in my opinion, but there is no real cost of goods sold here classified. So what you're going to do is, you just, as this is like significant information, you just write it down as the way they did. Then you won't get lost and you won't miss anything. Right, so I link this then. Change in inventory of unfinished goods. Let me quickly check. Well capitalized, double operating income. Okay, that's it actually. That's not so important for us right now. So cost of goods sold is, for us, cost of materials, because this is maybe the most direct link to the products. The materials you have to buy. Cost of materials, cost of goods sold are directly linked to costs to the materials or whatever you buy on the market and so on from suppliers, and cost of materials would be the most likely cost of goods sold figure here. Okay, now. Okay, this a little bit. Okay, so you're going to link this then. I will start with that. 2013. By the way, this is a rather big number. This is in thousands, right? So maybe it's too high. It's like too detailed for you, and you don't want to have this in such great detail. So what you can do is you can create at the beginning as an assumption section actually. So that means that you are that. Okay. The MacBook is always different, as I said before, it's always different. So to go here and then freeze. Thank you. So then you can say this is like, I want to have everything in millions. So this is in thousands. So what you can do is to have it organized, name a cell like thousands and plug in thousands and name this unit. So this is done in millions, in euro millions, and divide this by unit. So you now have this unit cell code. Every time when you plug in unit with an equal sign before, it will refer to the cell, so you don't have to link every time by hand this cell or anchor this cell. So it's always this cell, so that's fine with you then. And you can go on, copy everything across. By the way, Control Shift 1 is formatting it that you have 2 decimals in the end. Usually with the Windows computer, I have also some shortcuts over here. In this line, where you can, with Alt and 1, 2, 3 to 10 and so on, you can create some other shortcuts to have this on shortcut as well. So it's very, very fast. And anyway, I don't have it as with MacBooks here. Then you copy this cross because it's always the way down. Oops, there's something. Financials. That would have been other operating income. Another unit. So, right. So then we have our gross profit here. So you can say that the sum of this is my gross profit. You can make this a little bit nicer looking. Plugging in some borders in the mid. You know that this is a border subsection. Okay. Okay, so this is gross profit. Then we got some SG&A. Staff costs, SG&A, right? I hope this is clear. Then R&D, let's see. I think this is a processing company. I think they don't have pretty much R&D. I mean, this is a very innovative company, right? But they don't classify. They don't have it separately as R&D classified what they are working on. So they don't have it here. So let's delete this. Control minus, also Shift backspace. Control minus is deleting a row. Then other operating expenses. I mean, you will see later that this was not necessary, but I just do it because you can see what you can do. So then we got the EBITDA. Let's see if we got everything. Other operating income. What's with operating income? Oh no, it was here. Okay. Operating income. So this is straightforward, I think, for everybody. Nothing new. The new thing comes later. So this would be your EBITDA. Okay. Copy this format here. So this is your EBITDA, gross profit, then EBIT, D&A. Usually the D&A is taken from the cash flow statement, but as you are just plugging everything down the income statement, you used it from the income statement. I'm not sure if this is now correct. Yeah, because the shares of data, this is missing. Ah. Okay, sorry, I made some mistakes here. I used 2011 data. Very good, very good. So let's see. Fuck. Come on. Okay, so here, this is actually okay. J1, J. This was H. This is wrong. It's always, if you're very fast, you can make mistakes, of course. Okay, so anyway, so we got our EBIT and then the taxes and so on and stuff. So before we are going to plug that in here. So we are here in our income statement, then we move on over to our cash flow statement. So before we do this, we always, as we have 3 segments here, we also always model the segments of the company, right? So here you would add segments as well. So for example, they have a fruit segment. So you want the fruit segment to be shown as well. Then they have a starch segment and a sugar segment. So you add segment information as well. You plug in the segment information as well, because you always forecast each segment separately. Otherwise, it wouldn't be very detailed. It would be very, very rough. Because some segments perform better than the others. Some segments will be, don't know, really not important for the company in the future, and that's why you model them separately. This was sugar. Fruit. Starch. So then you enter some assumption cells here as well, like revenue growth. notebook is just very slow right now because I have everything running, and Excel is always combined with something. It's always difficult for it. So you plug in the change of everything, the growth rates. Then you can see how it performed in the last few years as well, how the change was. It gives a bit better understanding. Right. So fruit, for example, is the most important segment for the company right now, whereas it was started in 2013. So that's, for example, very important for you. Here, sugar segments performed really bad in the last years compared to other segments like fruit and starch. So the sugar segment is actually the least important segment for it right now. Also because of some market impacts recently. Then, so you always calculate revenue growth. Then you calculate the margins of everything. Like here, the margin of revenue. Relate everything to revenue. You always go with percentages. So here you calculate the margin. You anchor the number, like here, like 13 here, for example, because this is the row. So you would anchor the row here, and you can then just continue copy everything across. Here, for example, copy this, insert the copied cell here, and it will automatically calculate this. So it's not significant margins, but that's of course. Oh, here I copied the format as well. So, for example, cost of goods sold is like 78% on average for the last 5 years. So that's important for you. That's what you want to know. So, I said before, I want to show you how you can make some cases, right? So, as I said, you always model the cases, the bear case and base case and bull case, because you want to have a very conservative value, then a rather market-based, management-based assumption value, and then a very bullish value based on some assumptions you make that will be good for the company. And so when you do this, you always have to know. What I do always is I want to do this for all 3 segments and for the most important drivers. So what does it mean? So let's continue linking everything. Then I do this because otherwise it's gonna get a little bit messy. So taxes. Then we got the EBIT, right? Then D&A. So here D&A you always take from the cash flow statement, because there could be something classified in the income statement before, for example, cost of goods sold or some other things could contain already some D&A information. So you always want to take this from the cash flow statements, because here in the cash flow statement you are completely sure that this is like the really non-cash expense and not something the company has classified in another way. Then change in net working capital, we will come to that later, creating net working capital schedule, what we've classified here. Then the capex you take also from the cash flow statement. Where is it? The purchase of property, plant and equipment, and tangible assets, blah blah. So this is your capex. Capex are always expansion investments, so investments into machines, into some new facilities, into some, yeah, something that's not maintenance, something that's like a huge amount of cash that you used. Alright, so then we got our unlevered free cash flow. So that the network capital is missing. Just looking if this is all correct here, because it seems very high. Seems indeed very, very high. I think this is not correct here. Sorry, I should be fine. This is 300. I mean, this is not. I think I missed. This one. No. Am I completely off here or what? Come on. Why is that the case? I don't actually know. I've just plugged in the numbers here. That's why. The sum. It's always the problem with the sum function because it summarizes everything. Yes, that looks a little bit better. All right. So sorry for that. So here you say, okay, you create scenarios cell here, and you go here to data validation and create a list. So you just write in with your, how is it called actually? I don't know. Just plug in here base case, then bull case, then bear case. So you got here your different cases. Okay. Don't need this obviously. Okay. Base case, bull case, bear case. Yeah. So now you can also do some conditional formatting because you want to know quickly if you're now in the bull case, bear case, or whatever. You can see it if you format this like this. You say equal to. If this is equal to base case, you will have it as, for example, it looks rather normal. So, for example, yellow is like base. Okay, I should. Oh, that was the thing. Okay, yeah, you see. Rule. Base case. then you can do the same thing with bull case green or bear case red, whatever. Yeah, so for example, if it changes now, it would be not yellow anymore. It could be then green, bear case could be then red, and so on. So that's also a way how to keep it organized and everybody knows what is going on here, in which case you are right now. So then you can create some schedules over here. So just copy this section and say this is my scenarios. So here is my base case, here's my bull case, here's my bear case, and then I have to identify what are my most important drivers of a discounted cash flow model. That's also a very common interview question. So most important drivers are not growth rate or WACC or whatever. Your most important drivers are revenue growth, of course, then the margins, EBIT or EBITDA margin, then CapEx, capital expenditure margins, and D&A and cost of goods sold. So here we got, for example, 3 different segments. So you, as I said before, you always model everything for all the segments. So you have your fruit revenue growth, for example, assumption section. Then you have your starch revenue growth. Then you have your sugar revenue growth. Or let's keep this different, because you have, as we said before, we have the revenue for segment. So let's jump to the segment section. We have revenue for segment, so we can model revenue. We have EBIT after, and the CapEx per segment. So we're going to model this now. So let's say fruit, then the fruit revenue growth, then EBIT margin, and CapEx margin. And then same thing for sugar. Yeah, so sugar, not starch is next one. Sugar, then copy this cross, and then usually it's a shortcut as well, but with MacBook it doesn't work. So that's why I never use Excel when you have a MacBook. Use always Windows, it's very more convenient. So here we have our assumption sections. Same thing. So here we have all of our base case. So as I said, this is like yellow, for example. Then we can make it a little bit more formatted and say, and plug in some lines here. Yeah. So these are all base case. So we know just by looking at it, this is base case. Then let's have one section have the same thing only for bull case. Good. Then have the same thing only for bear case. So it's a rather very quick way. Come on, I can make it here. Let's plug in some borderlines as well. Classic. So this is all. Then this is like, for example, this could be green. Then this is not only formatting. I know it's really boring for you, but it's only just now about setting up your model, and then it's about modeling. Because if you don't do this at the beginning, and you stop working on it before you're finished, you may have no idea when you look at it later what you've done here. So bear case is, yeah, let's keep it orange. case is green. Error case is yellow, as I said before. Right, so perfect. So you now have created your schedule for scenarios. Before we continue working on that one, you have to also, as we model everything for each segment separately, have to also link it back to here. So sections for the segments here. So we got fruit, EBIT, margin, starch, EBIT. Oh, I can make this one. Starch, EBIT. Sugar, EBIT. Link this back to the segment. And your EBIT as well for starch. Is the right one? Yes. So you take after, because you count for the equity joint ventures as well, as I said before. Again, took the wrong one for. That's also because I made a mistake before. So here we take this one, EBIT. Right, so we could see, for example, sugar was the most profitable segment in 2013. Then there was a sugar crisis in 15 and 16 and 17, where now the sugar got more liberalized. And here you see now fruit is the most important, and starch is the most important segment in terms of profitability for Agrana. So, oops, nope. You linked it back. Sorry, not to your revenues, but to your EBIT, because sorry, the segment EBIT should be linked to the segment revenue, obviously. So then the starch EBIT should be linked to the starch revenue segment. Sugar, same thing. Link it back to the sugar revenue. Then you know the profitability per segment. So I always make this italic so I know that these are actual margins. So let's see if that really sums it up to the EBIT. No, it does not. Staff costs, operating income. Did you miss anything here? Revenue, sure. Yeah, I think that there was not. I mean, EBIT is always different from operating income in terms of accounting standards. But here they classified it as EBIT, so maybe there are some values inside in the. Would have to look into the segments as well, if they have some other figures included here. But anyway, usually this is only for your interest in terms of margins. And if you model each segment separately, you care about you start from the EBIT and then continue and go to the unlevered free cash flow. Yeah, modeling everything top down is fine, but you could miss something because of accounting standard or something. So here, that's what I would do is I would start here, for example, with the EBIT, then going down to the cash flow statement. This is only for my interest in terms of margins, how much they were before and so on. So let's calculate the gross profit margin, for example. So this is, as I said, not important. So let's include this. So exclude it. Then the EBIT is here. Perfect. Same thing with capex. You also said that we have different capex per segment given. So fruit capex, starch capex, sugar capex, then linking again, everything just linking now, setting up your model. Chuck this as well. Sugar. So, and if you have it here, have your anchors for the rows, you can just copy that and it will be automatically calculated. So this is now linked to your segment revenue again, as you can see. Sugar capex linked to the sugar revenue. Sections again. Right. All right. So we have got here now the section for capex, the section for EBIT, the section for revenue. So we have our three drivers classified. Then, as I said before, we have cost of goods sold also as drivers of your free cash flow. Why? Because of working capital later. And working capital later. And yeah, well, because cost of goods sold is very important for a company. So let's take this is cost of materials, percentage of sales as well, of revenue, and D&A. Why D&A? Because if you have some capex assumptions, obviously if you invest a lot into some plants, equipment, they have some depreciation afterwards as well, and you want to model this depreciation as well, because if you don't make any D&A assumption, and if your D&A assumption, like the margin is greater than the margin as of capex, you would assume that at some point you would have no equipment anymore, because everything is depreciated in the end. So that's the problem of the terminal value, and I will tell you in a few minutes what it is about. The terminal value. So, okay, that's very good. Now we have everything set up, and we can start finally. So here is also linking everything to your revenue per segment. EBIT margin. Capex margin. Yeah, same thing with starch. I mean, that's, yeah, very straightforward now. Again. EBIT margin. Capex margin. So this will be very equal in all three cases, because yeah, you don't do the three cases of the last years, and you would not make any assumptions here. That's only for comparison later. EBIT margin. Capex margin. And then, I mean, this is always the same, blah blah. Then cost of materials. D&A. So we didn't make any revenue assumption here. It's 3% straight. This is a very constant D&A schedule. If capex, it's not so straight, but also I think Ukraine has some constant investments into joint ventures, into new plants, into acquisitions, and so forth. So it should be constant, but let's see. Okay, yeah, very constant, 5% straight as well. Okay, so actually you don't have to do everything with what I'm doing here. It's like, so I'm only plugging the assumptions here. That's all I'm doing here. always the same. It's only for comparison purposes afterwards when you make your forecast assumptions. So now I can just copy this. Yes, perfect. All right. So now we've set up almost everything, I think, and you can then get started modeling, actually, like making your forecast assumptions. The very most important thing. So what's the case of that? Okay. Right. So we have our three sections here. We'll just make it a little bit more obvious that these are the sections here. There are three sections, yeah. And now we're going to create our forecast schedules. Oh, 2023 is a little bit too much, actually. 5 years, 3, 4, 5. That's not what we need. Ah, come on. Okay. So now we link here everything back to our assumption section. So this is our assumption sections here, a section here with the scenarios, right? This is everything we need to plug in. The other things are taken as straight as average of the history usually. Yeah, given that everything is very mature and very they were not like huge outliers or something. Otherwise, you would have to project everything separately again. But here, so let's link this back. For example, here we take this one, forecasting the fruit segment. The growth of it is like if this is base case, then we select this forecast for fruit. Otherwise, if this is bull case, we select this for fruit. Otherwise, if this is bear case, we select this growth rate for fruit. If otherwise, nothing. Don't care about this. Yeah, can close this actually. So when I plug in something here now, let's say for fruit, for example, they were on average 0.3%. I think fruit, as you have to make some expansion investments in Asia, China, and India, we can say that they are growing at the beginning straight at 4 something, and then moving upwards to slightly 3.3, 3.5, and I mean, This should be very conservative, so it shouldn't be too high, shouldn't be too low. So I think at the beginning, let's take like 4, then 4, then 25, and then 4.5, then decreasing, or let's say 5 at the beginning, then decreasing again to 25, and 4 in the end. So you would like to catch a certain section, business cycle here. Yeah. So your terminal value, the final assumption you got that goes into your terminal value shouldn't be too high, because here the terminal value is you calculate everything into perpetuity, and you assume that everything exists forever, like the company exists forever and operates forever. That wouldn't be the case, of course. That's of course not the case. So you want that your terminal value is not too bullish and not too conservative. It's just that every value that goes into your terminal value is a mature stage. It is on a level at which the company can sustain it forever. Yeah, it shouldn't be too high. Start, for example. Yeah, I mean, it's just plugging any number that comes to my mind now. It's not so much important for you. It's all you have to make your own assumptions for your analysis. That's of course not correct. It's very subjective. So you have to make lots of industry research before and company research before. So, for example, there was the sugar quota abolition in Europe. Europe sugar segment is the most European segment a grinder has. Starch as well, but sugar more, and so this will significantly impact it. So, for example, we should predict only a 0.6% growth at the beginning, then decreasing to 0.8, 1%, and then keeping it at 1% because we don't know what's going to happen here. You always calculate also the average before and CAGRs to cross-check your assumptions you are making, right? So here, for example, you calculate your average. Come on. This is your average. Of the historical data, last 5 years. Here as well, average. For each line that you consider important. Tax rate, forgot. So taxes are, I think, 25% or something. Okay, 20% average. Okay, then net working capital, we come to that later in a second. Just creating a very huge model here, that's why it takes everything so long. Okay. Okay, it's rather huge, but anyway. So then, I know it takes a while. So then you plug in some random numbers here, like, don't care now about what actually I'm plugging in here. Just doing it now. So we saw here, for example, this is a very, very straightforward CapEx schedule. So if we keep it at 3.5% or something, or at the beginning 2018 they make some expansion investments, like let's say 3 point in fruit, especially let's say 4%, and then decreasing again to the average. So same with EBIT. I don't care about this now. I just link this now, and we can do it later afterwards. Don't care about this either. Limit some capex investments for some capex for storage facilities as well. It's only setting up the model for you, that you know what you can do. Okay. Then you always calculate some keywords as well, but I will show you later why. Okay, so revenue. So then you link everything here, as I said, to the scenarios and the sections here. You do the same thing with all the segments. A lot of hand work that you have to do here. A lot of handwork. Okay, alright. Forgot to link that. You can name these scenarios usually, and then you don't have to link to anchor that here as well. Sugar revenue as well. Okay. Yeah, so if I select here, for example, now, okay, let's see what's with the bull case. I have no values here because I didn't plug in any values yet. So that works. Simple linkage, very, very simple. But actually modeling is not very sophisticated. So here, for example, change in inventory. I mean, don't care about this now because usually, I mean, you will forecast this with the average to see what's your gross profit for next years. And also, if you want to forecast income statement later, of course, so that's what you do. But for the free cash flow calculation, it actually doesn't matter. So do the same thing with the margins. Got to anchor that. Same thing with the margins. So as you can see, setting up the model is not as I would say very, very cool as you may have thought at the beginning. Modeling is so cool. Actually, most of the modeling work is handwork and boring linking, boring formatting. But you want to have it very organized in the end, otherwise you get lost later when you show it to others, or you have to justify it in front of others. So here you link it back to, oops, okay. So revenue growth is like, okay, what's the revenue growth? When you approve this, like the revenue like the formula, we add an interest, so 1 plus the growth rate, right? Same thing here, same thing here. And here it's just the sum of that, which is 3. Right. So this I don't care now, so it's not so important for us. Let's group this away. Yeah, so we started EBIT as said before. Then you recalculate the margins. The values based on your margin assumptions. Let's see if this works. It does work. So you can see already, okay, there are some slightly different values as we have here. Or here. Because I kept this constant, that's why. And in the end. So here we summarize this again. Oops, that's wrong as well. Oops, what the... Yeah, so sum of the three is the EBIT, right? So if all the three segments. Then taxes, I mean we keep the tax rate usually constant. We don't assume that the government is going to do any invent any new law or something for refiners, for companies, keeping the tax rate constant. Okay, it's as you can see, I'm really a lot on formatting. Most of you would never have done it in such a format detailed way. I hate Excel, if Mac. So this is minus again, right? Because here, so that I know that this is like tax rate cannot be a minus, obviously. So I did times -1. So now you have to make it negative again. That your formula here is correct. Then keeping the D&A is constant as well, I think would be nice. So let's assume that this is going to be constant as well. And cost of materials as well, because it's quicker. Right? Keeping it constant here as well. So here you link it to assumption section, because this is complete assumption section above. Then revenue times the assumption. D&A. So fine. Oh, let's finish the capex. Then let's come to working capital. So margins here as well. Capex. So always copy cross the whole lines, one after another, linking back. I hope this is not too fast for you. I mean, it should be straightforward. Otherwise, you can write an email or something. But it should be alright. Nothing special. But important to know how to organize your model. Or how you can do it and how I'm doing it. Okay, so linking again back to the capex margin, back to the fruit revenue. Just everything that you've calculated before, linking back. Right? So your final capex margin should be in a very same range. obviously. So your free cash flows are now also in the same range because I made some cross straight average assumptions, and you can change them later. So now we have the net working capital missing. So we want to create a separate working capital schedule, because working capital for many companies is a crucial thing, and people, if you want to if they want to make it quick and dirty, take it as a percentage of revenue, so a margin. But usually you have inventories, you have accounts receivables and payables and other current assets and liabilities that are not always the same. And you want to dive into you want to make a quick and dirty working capital analysis before taking the cross average. So what you're going to do is you're going to do a revenue working capital schedule. So that means revenue and cost of goods sold are the most important drivers of my working capital. I will show you later why. So you link back again the revenue here. It's just that you have everything organized. Yes, you don't have to look into each cell in detail. That's why I'm always writing down everything separately. Please open this shit. Thanks. So then, okay, we have current assets minus current liabilities, right? That's where working capital should be. Alright with everybody. Then, what are current assets? Let's look into our balance sheet. What current assets does my company have? We have inventories, obviously current assets. Then we have accounts receivables here, but they classified it differently. They said only trade receivables and others, and then cash. Yeah, so they included everything here: the reimbursement receivable, the amounts due to from affiliated companies, joint ventures, so also accounts receivables from Südzucker, because Agrana is a subsidiary of Südzucker in some way, and they have some other payments and so on and so on and so forth, which is not all of them is not accounts receivable. So you have to split it into accounts receivable and other current assets, and only take, okay, let's take here inventory first. Inventory as 13. You gotta do it again. And accounts receivables is now not the complete number, the full number, but now trades receivables is what we're looking for. Trades receivables, and the rest is other, as you can see. Divided by units. So other is what we're now going to write down here as well. Reimbursement receivable, okay, accrued prepaid. You can make it separate, let's say, okay, accrued income, prepaid expenses, accrued income, because this is not the same. Accrued is actually what you receive before, what the fuck. Okay. prepaid is also usually given separately. And not huge here, but and the rest is other current assets. So we said this is other, this is other, this is other, this is other, this as well, this as well, this as well, yes, this also. So huge amount of other. Usually look into the notes what that is really, what really goes into all this different lines here, because you want to understand the working capital schedule they have internally as well, but we're not going to do this now. Take too much time, of course. So then we have the current liabilities. Let's see what goes into current liabilities. Current liabilities is usually, yeah. So working capital is actually current assets minus current liabilities. So what is bounded in your assets? The more working capital you have, obviously, the less cash you have. This is why you subtract it when you go to the free cash flow, when you calculate the free cash flow. Yeah. So what's bounded in your assets? That is what you care about, the company. So trade receivables, for example, is accounts payables. This is obviously current assets. Then the rest is like maybe the rest is other. The rest I would classify as other. Okay, the rest is classified as other. Other current liabilities. You don't care about each segment, each number in detail. Why am I doing everything, every cell separately with a plus? Oopsie. Because if you just take the sum and you insert some cells and some values then again in your financial statements because you missed something, you will have the same problem as I had before, and the sum is it is included in the sum, and even though you wanted to have it, you didn't want to have it included in the sum. So this is why I select every cell by hand separately. So current liabilities. It's pretty small. Let's check it with my. This is a real model. If I have done it right. Yeah, as you can see, this is a very complex working capital schedule here. Yeah. But don't let us go into too much detail here. I mean, this is always depending on the company. Okay, so working capital is then current assets minus current liabilities. But you want to have to change in working capital because you care about how much cash do they have now released compared to previous year. For example, here they had 800 millions bounded in assets. Now this year they had 700 millions bounded assets. So this means you released 91 million of cash. That's not in assets bound anymore. That's free. So that would be now added to your free cash flow, because in your free cash flow you subtract working capital. So minus and minus will be plus then, right? And here you have to also go for the previous year, 2012. Yeah. Right, so we care about the change here. And how do you forecast this, all these figures? Actually, there are some certain figures called days sales outstanding, the number of sales you wait for the customers to pay you for what they bought. Then days inventory held, how many days is the cash actually bounded in your inventories? So how many days do you have your inventory, and then sell it? Then the other things can be calculated as percentage of revenue. Prepaid, the current assets revenue. Then same thing with the working capital after liabilities. Those are days payable, outstanding, DPO. You have to remember this shortcuts, abbreviations. Other current assets are liabilities, percentage of revenue. Yeah. So you calculate this by saying inventories goes first, sorry. Inventories are a percentage of, sorry, I have to link this now, 12 minutes sound cost of goods sold, cost of materials, because you need one figure in the past more in your working capital schedule, otherwise you can't calculate the change in working capital for the current year, for 2013, because and so you have to make an assumption, and that would be not correct. So that's why you need one year more here. You need to change. So days inventory held is inventory divided by cost of goods sold times 365. So times the number of years are days in your year, of course. So the margin of cost of goods sold times 365. Why cost of goods sold? Because cost of goods sold, or cost of materials as it is called here, is the figure that gives you the number, how much you bought from suppliers, how much materials, resources you bought, and again in this case later refined it, but stored it in the mid intermediary, right? So that's why a percentage of cost of goods sold and not of revenue. The driver of inventory is cost of goods sold. Times they have pretty long days where they hold the inventory. These sales outstanding, this is driver is revenue, because you make revenue with somebody when somebody buys your goods, correct? So the rest is only a percentage of revenue. And I link this, I anchor this, so I can just copy this cross, as you can see. Yeah. This payable outstanding, the driver here, is also cost of goods sold. Why? Because you pay suppliers for your materials, and your materials that you bought goes into your cost of goods sold. So that's why. So this is, I make this percentage of sales because I don't know what's like directly in there. So you would have to also see if this is correct or not. But as long as you are consistent with your assumptions, it doesn't matter pretty much. Okay. So these are your assumptions here for working capital. Of course, assumptions. Then what you're gonna do is you make also calculate also the average of everything and link everything back. If you think that these numbers are very straight and there's no big change. For example, here there's no big change. Here, slight change. You can't say that there is a cycle. So maybe we should account here for like, okay, 6%. Let's keep it like 6%. That's a good amount. Here, there's also no big change. Yeah, no big change. So we project everything then into the future. Assumptions is always what I'm doing. And the major assumptions I make is always I make it obvious that there are assumptions that were made. That's important, I think. So I keep this now straight. Anchor the column T. Okay. So and then we add this back. So here we link the revenue back. Let's make the forecast of the cost of goods sold again. So link this to the revenue section, to the assumption section. Calculate the percentage of sales. So yeah, so this is only basically this times the revenue. Assumption you made here times the revenue. So and if I copy this cross, I will have it linked here as well. Then inventories is the cost of goods sold times days inventory held divided by 365. So you solve the equation now to get the final number. Just solving the equation you've done before. So this is same thing times days sales outstanding divided by 365. Actually, you can anchor this now and let it calculate all the way down. Because it's minus. Oh, yeah, because this is minus this figure. So times days payable outstanding divided by 365 again. Same thing as with inventory. Accounts receivables. This is only percentage of revenue. So let's calculate it as a percentage of revenue. Yeah. So watch out that this is correctly linked. So as you can see, our working capital change is now a little bit smaller than it was before. So we would have to check if this is correct. But anyway, everything is positive. The average is minus 12, and here it's plus 23. So we would have to make some assumptions that this is actually better. But anyway, I wouldn't say that the working capital is negative in the long-term future. So yes, if this would be completely off, we would have to make changes in our assumptions and not just taking the average. I mean, then you could have also taken just a percentage of sales for working capital. But we don't have the time here. I just wanted to show you that you create a working capital schedule where you can make some assumptions per each line, and that you have to classify your current assets, liabilities as working capital before you do it. So dive into each node of each line and see if this is a working capital or not. So working capital, let's link this back. Change, so that's my change. Right. Perfect. EBIT as EBIT minus taxes plus D&A minus change in net working capital plus minus the capex. So this is no plus because it was minus before, but it should be minus, of course, because it's capex. So let's check this again. So perfect. So they produce around 70 and 65 on average free cash flow, unlevered free cash flow for the next 5 years, and here they produce around 109 on average. Well, of course, you have to, based on assumptions, you will come to other numbers then. But that's actually how it works in terms of modeling. So now we set up our protection schedule here, based on what we find on previous on historical data, on business cycle where they are in, on industry information. So we made our assumptions. Let's assume that we made our assumptions correct. Considering tons of information, we read many research reports, many research papers on the company presentations. What is the management assumption? We tried some equity research, some ad hoc calls with ER analysts and so on and so forth, with investor calls. Thanks. And then we made our projections based on this and this and this and this, and we justified it based on whatever. Yeah. So we are all set up now. So terminal value. It's not that we got everything. We have made our base case assumptions, our bull case assumptions, our bear case assumptions, because here we can say, okay, the recent sugar quota evolution will have a significant, a more significant impact on the company, and in bull case we assume it doesn't have any significant impact and everything is fine. Margins are increasing on a strong amount. Yeah. So typical bull and bear case assumptions. Now we are in the base case and we have made our projections. So now we have to calculate terminal value. And there are two methodologies to do that. The first one is with the perpetuity growth method. For a perpetuity growth method, it assumes that the company grows at a certain rate forever. So we have to calculate the discount rate and the growth of the company. And then there's the excess multiple method, where we assume that we can sell the company in the final year to a private equity investor or whatever, or to another company at a certain multiple. Yeah. So let's calculate first the perpetuity growth method. As I said before, we would need here first the discount rate and the growth rate. For the exit multiple method, we would need the exit multiple. So again, this is an assumption, so I classify this as assumption here as well. Did I know later this was an assumption? Make some formatting. So now let's calculate the discount rate first. There are two different discount rates. I mean, there are lots of more, but we can use the WACC if we say we want to calculate the value of the company for both debt and equity holders, as we have done now. Unlevered free cash flow, we're going to use the WACC, which is the weighted cost of average cost of capital. So we weigh the cost of equity, that is an interest for the equity holders, time with the equity ratio. So how much equity does the company have, plus the cost of debt, which is important for the debt holders, like the bond holders, the banks and whatever that granted the companies and bonds, and times the debt ratio times 1 minus the taxes, because that is tax deductible, right? So how do we do this? There's one easy way to calculate the cost of equity, which is called CAPM. So cost of equity can be calculated with CAPM. The CAPM is basically the risk-free rate times the beta times the market return minus the risk-free rate again. Yeah. So the market risk premium, it's called. This is the cost of equity, right? So risk-free rate, we usually take a 30-year. Always say what we've done here, what assumption you make. 30-year risk-free rate, because that should be definitely risk-free. So I downloaded here the bond rates for Austria as of February 28th. Yeah, the bond rates for government bonds. So government bonds are considered as more or less risk-free for 10 years or 30 years. I take 30 years because that is also what Big Four companies are taking. Then beta, we will calculate this later. Then we need the market risk premium, right? So market risk premium is calculated with the market return time minus the risk-free rate. So the excess premium, the excess return you get for a market and invest into an index, for example. So for market return, we take an index. And here we can take let's go to EU Finance. Let's go to EU Finance. You can take, for example, as this is an Austrian-based company, we take an index that best captures the market. So that would be the Wiener Börse index, for example, which has 60 constituents. The ATX has only, I think, 22, 23, and so it wouldn't capture all the companies. It wouldn't be a good proxy for the market. So let's take here Wiener Börse index. The Börse. Yes, it's still recording. Yes. Wiener Börse. Okay, index. Okay, you know what? Let's do RTX. It's pretty much quicker, but it's not that correct actually. But it's quicker because it knows in RTX. RTX here would have to search in long hours. I mean, internet is really slow here on the countryside. You know what? Okay, I don't mind. It doesn't work here. Okay, ITX and return should be 9.1% or something like that. Yeah, the risk-free rate is the same one. So the risk premium is then just the excess return, as I said before. So y minus risk-free rate, because you say, how much does the market have to pay me if I want to invest not in risk-free bonds, because I could just only store all my money I have. I would like to invest into a 30-year bond, then would get 1.4% for the next 30 years straight each year. But what if I want to invest in the market? Then the market would have to pay me like 7% more. So more should get 7%, 7.7% more return in order to invest. That's my threshold. So beta, you can calculate here the market beta, which is basically only the regression to the slope between the index, the market return here, the index you've taken, and the company's share price. To know, beta gives you then a value of like 0.4 for a grana, which means that it is like 30% less volatile than the market. The market would have a beta of 1, obviously, because the market is the market, and you measure the beta measures how much more volatile is a company compared to the market. So here it would be 0.4 only. You can also calculate the beta with, so you would go to Yahoo Finance, download the index data monthly, past 5 years for both the index and the grana, calculate the slope out of it. So there's a function which is called slope or Steigung in German, and of the returns, select the returns. So first calculate the returns of the index and of the prices, the values, and then take the slope. One approach. Another market-based approach is to calculate the peer group beta. So why peer group beta? Because a grana for here, for example, has only, I think they have only 90% free float. It's the least free float an Austrian listed company has. So it could be biased and couldn't be heavily traded. Grana is also not that much covered by companies, by research analysts. So that's why you say, okay, you want to have a beta that, I mean, you're going to assume that my beta should be, my target company, Agrana, should be equally volatile to the peers, because you have previously selected your peers. The peers should have a very similar business model as your company has, and therefore you are going to assume that your company should be equally risky as your peers if they have a very similar business model, right? So that's what you are going to do here. So let's calculate beta based on the P group. So you say, okay, P group beta calculation. You just, so this is what I've screened before in Thomson Reuters. This one, then made some quick and dirty calculations, and so on and so forth. Yeah. So these are my peers again. This is my target company. Yeah. Company name. So here I have my levered 5-year beta, right? Then I have my, so you see 0.4 only. Market cap. So you want to have, you want to, as all the companies have different, usually different capex schedules, different G&E ratios, and so forth. You make it capital structure free. Make the beta, because the beta always accounts for capital structure as well. If it's a very risky company, it should have a higher beta. If it has a higher D ratio, it should have a higher beta. If not, a less higher beta. For example, like Ryan has a very low D ratio. So what you do is you calculate D ratio, the debt to equity ratio, and you base it on market value. So you don't take the equity of your balance sheet, yeah, not this one. Where is it? Not this one, but your market cap. Market cap is simply shares outstanding times share price, and this is market based. So this is the market cap based on as of valuation date February 28th, right? You want to have a market based value here. Sorry. So the RD ratio is not very high. It's very good. Here it's even negative, so let's exclude this company then. Negative net debt. That's very interesting and very good. So here, calculate the median average of your D ratio. And tax rates. So usually you would have to search for tax rates of the companies as well. I forgot to plug them in here, but you can I have them here actually. The companies. So for Ghana I have 23% tax rate. Then for Südzucker, same. Ebro Foods, 33. Associated Pretty Foods. You always take the effective tax rate. Always keep this in mind. Then Rosagro, 7%. This is Cyprus company. It's completely different usually, but we include it here as well. Then Badarampur, it's a Chinese company. Then Ingredient, because they have also some segments. China, Agrana. That's why we also have some Chinese people, guys here included. Okay, so then we calculate the unlevered beta. So you go from a levered beta and calculate the unlevered beta, which is you make the beta capital structure free. So what is my company? What is the risk measure, the systematic risk for my company without the capital structure now? So this is divided. So the levered beta divided by 1 plus 1 minus the tax rate, because debt is tax deductible times debt is tax deductible times the D ratio. There are a bunch of other methodologies that you can apply, but this is actually the most common one. Levered beta divided by 1 plus 1 minus tax rate times the D ratio. It's a very common way to do this. And here you calculate also with again the median average. So for Grana, I would assume now that I take this number here, the average, and relever it finally. So you have now the unlevered beta, the median of the peer group, the average of the peer group. So the systematic average, systematic risk of your peer group without the capital structure is 0.54, and now you're gonna relever this with your own target capital structure of your own company. So this is basically this unlevered times 1 plus, again, as times, not divided now. So you solve the equation again, times 1 plus 1 minus tax rate of your own company, times, now you have just to know if the company is right now in that target capital structure. If not, you say you have, if you don't know it, you go into the notes of your annual report again. You have to join some calls, make some calls with the investor relations, if maybe they can give you some hints, and then make some assumptions what could be the long-term target capital structure. But Agrana has only one big bond. Yeah, I mean they have a few bonds, but like one really big bond, and their debt is not really high, and they have never had a high DE ratio. So, and as the peer group average is also 0.21 and the Agrana average DE ratio is also 0.21, we can assume Agrana is right now in the target capital structure, and who has no intention to change it in the long-term future. Yeah. So you just say, okay, you assume now, okay, this I relever it and say based on my target capital structure, which is the same as we have it right now because it is already in the right capital structure. And now my relevered beta is 0.63. So that's way different. That's almost double of what it is right now, based on the market beta. Based on the slope regression beta. Yeah. So here, this is what you have to know. That's why we are doing it, because you want to know how risky is the company compared to its peers. If you assume that the market regression beta is biased. So we take this one. So for VAC, now my beta is 0.63. So my cost of equity is simply referred times beta times the market risk premium, right? So straightforward CAPM calculation. So my cost of equity is 6.3%. Cost of debt. Now we have for VAC, we have also to calculate cost of debt. Cost of debt is, there are many ways how to do this. Usually you look into the company's financial statements, notes, into their, where you make some notes about their bonds, the financials they have outstanding. Let's do this quickly. Let's search for it. Bonds, revenue, depreciation, amortization schedule, income, tax expense, earnings per share, don't care about this, cash flow, blah blah blah, property, plant and equipment, important for D&A schedule, some segment information again, receivables also important, inventory is also important for your working capital analysis, provisions important, then whatever that is, then pensions are also important, trade payables important. Right, here we got it. Notes on financial instruments. Here we see this is investment and credit transactions, non-derivative instruments, so that's important also, because derivative instruments carry no interest. And for debt, we only care about, and for calculating cost of debt especially, we only care about debt that carries interests, and these are bonds. So market-based. Here, we have the debt schedule. Agrana only gives us the average effective interest rates. Usually, for all the maturities, for all the bonds and maturities, you get the interest rate for each bond. Here they only took the average. We don't know how many bonds they have. We don't know how the interest for each bond. So they just give us average. So what you can do is you can take you can you can take just write everything down, like write on the complete schedule. So average interest, then they have 543 total, then 276 is due up to 1 year, 1 to 5, 85, 90, 92, more than 5 years. So what's wrong here? Annoying. Okay, and then you usually, for cause of that, you weigh the bonds with the years and the interest rates with the years. So here, for example, we weigh. So here we weigh how much of the percentage of debt is due up to 1 year. Oops. So this divided by the total amount. So 61% is due up to 1 year, and 20% is due up to above 5 years. Then more than 5 years. Then weighted cost of debt. So then you're going to weight your interest rates according to the bonds. Here we just have weighted average, the average interest rate, which is why we just weigh this one with the amount with the years where it is due, the percentage of the debt to the years where it is due, and then. So why are we doing this? Because then we want to calculate the spread. Why the spread? Because a debt holder, a bank, would not grant you usually the bonds to the risk-free rate right now, because they also want to earn something, right? So they want to have, based on your previous credit history, based on your credit rating and so on, you would grant you another loan for another interest rate. So that is typically higher than a risk-free rate usually, because you want to earn something, right? So what I then calculate is just the spread, the excess premium. Again, same as market risk premium for equity, is here the spread. And here I use for less than 1 year, we have an interest rate for Austria that is negative. Then up to 1 to 5 years, I just take here the average. So 2 to 5 years, the average of it. And same with here, average more than 5 years. We don't know how long these bonds last until they are due. We don't know it because they don't state it in the annual report. You can make some calls with the investor relations again, but maybe they don't disclose it. So you have to make an assumption, and I would say 6 to up to 30 years is most. I mean, that would be absolutely the longest time, I think, a grantor would be granted a bond. So let's also take the average here of the bond rates. These are actually the bond rates. Yeah, sorry, the risk-free rates, the bonds for the different maturities. This is the spot rates. Another forwarded rates. Sorry, the forward rates. You have to can download these forward rates from investing.com or a bunch of other free sources. Then risk-free rate, because we use here the 30-year, because again, this is now you have the spread, and then you have to add back the additional risk-free rate that like what would the cost of equity, cost of debt for a debt holder now? And this is why you have to add back the 30-year risk-free rate again. Hope this is understanding for you. So the final cost of debt is 4.1%. This is one methodology that you can use. You can use also another. Let's say, okay, the interest expenses are a percentage of net debt. Yeah. So this is the most basic one you can do. Cash equivalents. So net debt is cash minus cash equivalents. So here you have like 2013 plus blah blah up to 17. Take the interest expense of the historical years and figure out how much you paid in history for the bonds on interest. Okay, so 60 million up to, okay, it increased to 69 again, and then now it's at 31, so close to the average for the past 5 years. Then total debt is long-term debt, long-term borrowings plus short-term borrowings, and basically everything that carries interests. So you have to look into the notes if something here would be would also include interest payments. Retirement and termination benefit. Usually pensions include interest as well, because pensions, they give it to they invest it into an insurance company, and they invest in other assets, and they earn some interest here. So that's why they carry interest here. The pensions and provisions sometimes as well. Sometimes, so look into the notes. So the cash and cash equivalents is stated here. Usually divided into cash and cash equivalents. Cash, like direct cash, and short-term investments. Short-term investments are also considered as cash. So you add them to cash and cash equivalents. But here we don't have the split. Short-term investments are like very 1 year or shorter than 1 year investments that the company makes, and that can be easily transformed into cash again. So net debt is 403 in 2017. Then interest expenses as a percentage of net debt. Why net debt? Because you assume that cash, the cash is the first figure you're going to use in order to repay your debt if you have some troubles. That's why interest, the percentage of net debt. So let's take the average here as well, because we took the average here, there as well. It's 10%. Okay, that's way higher than we have it here. So you have to look into your numbers. Why is this so high here? Look into the notes. If something happened here, if there were a major repayment or some maturity or something, so usually I would say that this is an outlier, and then it's better. But look at the numbers, and as I would always go with the other methodology and see into the debt schedule of the company in the annual report and weigh the interest rates according to the bond maturities, applying a spread and something. That's always what I would do, because that's more with the view as of a debt holder. So cost of debt is 4.1%. So then we now weigh everything according to the capital structure. So weighted average cost of capital. Let's calculate WACC calculation. WACC calculation, weighted average cost of capital, cost of equity ratio. We need the equity ratio, then we need the debt ratio, then the tax rate, then the cost of debt, and then we got the WACC. Okay, so equity ratio is basically you have to keep everything market based. Always market based. So cost of equity is market based, cost of debt is market based. So also capital structure has to be market based. And that's actually this formula over here. Yeah, there's a very cool formula. C stands for the interest paid in the last year times 1 minus blah blah blah, 1 minus blah blah blah, divided by 1 plus the cost of debt, powered by the average maturity of your bonds. So we have to figure this out. Plus, FV is the market cap. It's the total debt, sorry. So foreign, it's called foreign value here. So foreign is debt. It's other people. The 1 plus cost of debt and the same thing, yeah. So what you do is you now have to figure out the weighted average, the weighted bond maturities for the T. So if here less than 1 year, let's say 1 year, 1.1 to 5. I mean, usually you have like for each year the bonds, but they don't have it here, so you have to make an assumption. 2.5 and 5, yeah, let's say 10, because 10 up to 30, but I think 10 is like a long period for a long term. So let's say this is most of them is due in the first year, then they have something due in the next 5 years, and everything above is due, and 20% is due everything above. So their weighted bond maturities, the T is 3 years. Yeah, I hope this is clear for you why I'm doing this. If you have some comments and you don't agree for me and I'm doing some big mistakes here, well, please let me know. Because I'm always here for improvement, right? Or everybody wants to improve, but that's how I would do it. So equity ratio is then total capital total market cap market value debt. So market cap is the market-based equity, of course. Market value debt is the market-based debt. So you don't take the debt from the balance sheet, like short-term, like we did here. We have short-term debt, long-term debt, pensions, and provisions. You take the total debt, the market-based debt. So that's this formula over here. The interest rates, interest expenses times the 1 minus 1 divided by 1 plus the cost of debt over here, powered by the weighted average maturity, right? And everything here divided by cost of debt again. So this is one figure, then the next section of this formula is plus total debt. So that's now book value, divided by 1 plus, so you weigh this again, plus 1 plus the cost of debt. You will find this formula on the internet, just type in market-based debt. Right. So that's my market-based debt. 620, and we got here 600. So they're slightly off, but not too much. That's good. That's also a cross check for me now. So market cap is market cap of Agrana, right? Then total capital is just the sum of those two. So this is now my total capital, blah, blah, and equity ratio is then market cap divided by total capital, and this is just 1 minus the equity ratio because it has to sum up to 100. Right? Tax rate we heard before about 23%. Cost of debt is 4.1%. So WACC is then the cost of equity times the equity ratio plus 1 minus the tax rate, because debt is tax deductible, times the cost of debt times the debt ratio. So that's very low. Something's wrong here. Shit. Oh, that's too low. What happened here? Cost of debt. Right, better. So usually 5.4% is also very, very low. It's like nothing. And this is why the perpetuity growth method is now really difficult to use. You should use it if you have to know what you do. So discount rate is not better, is the WACC in our model. Usually a discount rate should be around 7 to 8%. So if you do a quick adaptive financial model and you do it in a mature market like Europe, you go with a WACC of 7 to 8%, 6 to 8% at current values. If you go to Turkey and value a company in Turkey, you go with a higher WACC, double-digit WACC, like 12% or something. If you want to do quick and dirty, and yeah, that's usually what you can also do, but here we calculate by ourselves. Growth rate is, let's say, 1.5%. Why 1.5%? Because inflation is currently at 1.5% or something, and the GDP growth is also, I think, 1.8%. And if you assume a growth rate that is higher than the GDP and inflation, you would assume that your terminal value afterwards is like that after a certain amount of a certain year, the company captures the whole market. So in the long term, a company cannot grow on average above the market growth, right? So GDP growth, inflation, that's not possible. That's why stay always below GDP and inflation, or in line with it, maybe slightly above, but you have to justify it. Okay, so let's calculate terminal value then. So now I'm going with the perpetuity growth method. So terminal value with the perpetuity growth method is the free cash flow in the last year times 1 plus the growth rate divided by the WACC minus the growth rate, and right, that's your terminal value. So how much is the excess? Go to the excess return again. 5% minus 2% growth. If the company is growing at 2% all the time, 1.5% all the time, you would earn the excess return. That's why divided by WACC minus growth rate, and that's pretty high, pretty high. Anyway, let's keep it like that and calculate the present value of all of free cash flows in the terminal value. The present value of free cash flows and present value of terminal value. So what you can do is here, to make it really dynamic. So these are your discounting period. So this is year 1, 18. You discount it back 1 year to 2017 annualized. So end of 2017, then 2, 3, 5, yeah, because 5 to 22, and terminal value is everything after 22. That captures everything after 22, and you have this value here as of 2022. That's why you discounted also back 5 years to the present value 2017. December 31st. Yeah. Usually you can calculate discounting period. That's again the end, right? But usually it's also mid-year discounting. What does it mean? Mid-year discounting. Here you can see, wow, all these figures discounted back exactly 1 year, like 2018. I calculated back to 2017, and but all the free cash flows, all the cash flows my company generates, are not just earned at the end of the year, but mostly in the middle of the year and throughout the year, right? Throughout, not just at the end of the year. So what you do is a mid-year discounting gives you this assumption that you earn the values in the middle of the year. So what you do is you just you account for that, divide it by 2. That's your mid-year discounting. That's what you can do. Let me check quickly if I'm telling you correct things. Right. Exactly. So I'm saying, okay, yeah, that's another thing. I'm saying now, as of 2017 year end, so we assume here we are in the first quarter. So you discount it like 3 to 4. 4 quarters, 3 to 4, right? So you have this number is end of 2018, and you discount it back to by 0.75 as discounting period. Then you would have it earned as of March. So we are now March, first quarter, right? That's why I divided by 3. 3 divided by 4, and then you can just add 1. So then you will account for that. Alright, so far so good. So then you have to calculate the discounting factor. Discounting factor. So this is basically 1 divided by 1 plus the WACC, discount rate, time powered by, now I have to choose. Do we use the discounting period? Do we have to do we choose the mid-year discounting? Well, that's the question. You can make the same thing as here, a data validation. Let's say data validation, create a list, mid-year, full year discounting, right? So you can make a formula again. If this does not work, if this is mid-year, then please apply this formula. Otherwise, please apply the full year. Right? That's it. Let's anchor this. Ref. Very nice. Why is it ref? Because there is no value. So mid-year. Mid-year. Okay. If one, what's that? Okay. No. Alright. It's a pretty long video now. Sorry for that. But then you are ready to go. You have to link your rec again as well, of course. So right, that's now. Mid-year is this discount rate. Full year is that discount rate. Yeah, that works. Pretty good. Pretty nice. So now we calculate the present values by just multiplying the unlevered free cash flow in 2018 and so on and so forth by the discount factor. Sorry, that's 1 divided by, and that's also 1 divided by. So 1 divided by discount factor. That's now an adding factor, not a discount factor. Yeah, now it is a discount factor. Okay. Something is wrong here. No, it's okay. It's okay. Just checking. Okay, this times this. Right. So the sum of the present value. The sum of the present value of my unlevered free cash flows are finally this 5, right? Present value of free cash flows. And terminal value, because this is my terminal value. So let's right. So this is the sum of them, and this is the sum. This is only the link of this one. And now, as we add everything back, add everything, that's our enterprise value finally. So enterprise value is the sum of those two. Right? So always, of course, I just said that the terminal value is always the biggest, one of the biggest issues in your model, and this hurts your model most. So you see the present value of your terminal value is pretty high. You always want to have a terminal value in a certain range. That is not higher than like 2/3 of your model, so 75%. You want the terminal value that is always in the range of that, and not like 90%. If the percentage of enterprise value if the terminal value as a percentage of your enterprise value is higher than like 80% or even more, that would be a lot. So 83%, that's a lot. So it means my present value of terminal value the terminal value now accounts for 84% of my whole enterprise value. And as we said before, the terminal value is like where all your assumptions go in. And it's like you have to be really careful that in your final year you have numbers that are you have the mature numbers. Like there's a life cycle, and you want to catch the exact point in your life cycle where you say those figures, as I said before, can be sustained forever. Not too high, not too low, just a good amount. And that's the difficult part here. And of course, the discount rate is also very, very low. That's also why terminal value is so high, of course. But yeah, let's keep it like that. We don't have time for making so many adjustments all the time. So 75% would be fine. Below 80% would be fine too, but above, that's way not good. Right? So now we calculate equity value, which is just net debt. So net debt, what does it mean? That means short-term debt, long-term debt. That means it includes minority interests. Minority interests are actually both debt and equity considered, but you consider it as debt. And preferred stock, same thing. You just have to pay higher dividends for people who don't care about their voting rights. So that's why they get higher dividends paid, and this is something you owe them. So that's why it's considered as debt as well, right? So equity value, short-term debt. It's just so short-term debt is this figure. Oops, this long-term. Current borrowings units. Long-term. That is this one plus, we said, retirement provisions. We don't know. We'll have to look into notes. I'm not doing this now. Minority interest you will find usually in the equity. Non-controlling interest. Non-controlling interests equals minority interests, right? Preferred stock. I know that I don't have one. So 0. You will also find preferred stock in the equity. On the equity side of the balance sheet. The passive side. Right. Adding this up, it gives you the equity value. So now let's see what share price do we get. So divided by the share price, shares outstanding. You always take the diluted shares outstanding. As this is an Austrian company, Austrian and German companies have very infrequently diluted shares outstanding. In the US, it's more common to grant employees some shares. So you'll find this here as well. So the share price, estimated target share price is finally way off. Oh, sorry, let's take it. Complete mistake. Sorry. So minus the debt, right? Minus net debt. God, what am I doing here? So this is your net debt, right? Sorry, this is my net debt. Net debt, thanks. So plus, same thing. If you sum everything up and you want to add something, you don't want to add just for comparison purposes. You add it to the sum, and that's why you select each line here separately. So cash and cash equivalents, financials, cash. So this is plus net debt. Sorry, this is total debt. Total debt. Yeah, net debt is this 2 minus cash. This is something you would include into net debt. Okay, so anyway, so enterprise value minus debt plus cash is your equity value. So target share price would be 84 now. The current value of Agrana, let's see, is I think 90, 96, something like that. Agrana, 96. So that would be like a very bullish now, very bearish could be the bottom line actually evaluation, but that's only because we haven't included any sound assumptions. We just said that this is everything here is equal to the average. Yeah. So usually you will make some assumptions because EBIT margins for, especially in sugar, I know that the company has some aspirations to make some big EBIT margin improvements. From starch as well, capex, they have some investments here, but they will decline in the long term in starch, and so on and so forth. Yeah. But so anyway, just about the methodology here. That's important. So and usually can click here, like for example, then only a bull case, and it gives you some numbers, but we haven't included any numbers, so it wouldn't give you anything. But everything now is linked. That's very good. So you make an easy bull, bear, and case comparison afterwards. There's another methodology that you can apply, the extra multiple method. Extra multiple method, as I said before, you assume that your company is going to be acquired in the final year at a certain multiple, and a certain multiple could be similar to your peer group multiple, like the last 12 months multiple is here, 6.1, it's very small. Let's say it's should be around 9. So let's try 9. EBITDA multiple. So extra multiple is EBITDA is 9.73, and you can make here another one, another data validation list. Yeah. So like here, drop down menu. So PGM, EMM. So PGM, perpetuity growth method, or extra multiple method. So here we make another conditional formatting. PGM, EMM. So, right. So if this is, plug in another formula. If this is PGM, apply me this thing here, please. If not, please give me some extra multiple terminal value. So we just said we have the EBIT multiple. I thought it was EBIT. If not, I will change it. EBIT multiple. We did everything with EBIT, so we stick here to EBIT as well. EBIT times 9.3 EBIT multiple. Let's see if this is correct. And this is my terminal value actually. So EBIT in my final year times the multiple I'm going to assume that it's going to be sold, 9.7, is actually my, yeah, my terminal value, right? So let's see if this is correct. Oops, nope, it was EBITDA, so 14. 14 multiple, it's going to be sold in my assumption, because it should be sold and multiple that should be equal to what is to your peer group. You can also screen for transactions using merger market and screen for comparable transactions, and then say, okay, based on this transaction multiple, historically paid for similar companies, my company can be sold at this multiple as well. Yeah, but here let's use it. Let's use this one. So now if you say here, please EMM, it gives another value which is fairly higher, 86% of your total enterprise value, than using the perpetuity growth method. So maybe the PGM was not that bad, right? So that's a point value. Finally, before we finishing up, you always create a range of values, of possible values. So you create a sensitivity table. So we create a sensitivity analysis. I'm going to show you how to do that as well. Let's mark this here over here. Sensitivity analysis. So you can make out of everything that sensitivity. Revenue growth, exit multiple growth, VAC with growth rate. Usually the first thing you're going to do is to analyze the sensitivity based on the discount rate and the growth rate, because the discount rate and the growth rate always impacts your model most. Why? Again, terminal value and discounting. It's a 1% change in your growth rate if it's 1.5, or your discount rate if it's 5%. It has of course a higher impact than changing the growth rate of your revenue by 1%, right? So I hope this is clear as well. We can try it. I don't want to change this actually now. I don't want to do this. Don't want to change this. But usually we can do it here, like 4%. Like 60, the share price increased by 60, right? So just because we changed it by 1%, then growth rate 0.5%. Let's try 20. So the growth rate of your revenue wouldn't have that high impact. It would have a high impact, of course, maybe up to 5 to 10 or something if you change by 1%, but not 20 or 40. I mean, that's half of what you got as a value here, right? So that would be not that high. So VAC. Make a sensitivity. That's why you make first sensitivity out of your VAC and your growth rate. So let's create our famous sensitivity table here. Growth rate is 0.1%, 0.1%, 5%, sorry, 1.5%. So this is minus 0.005. Suck. So you always start in the midpoint value here. Start at the midpoint. So here at growth rate back. So midpoint 1.5 we assumed 4.5 5.4, and this is your midpoint here as well. Yeah, so how you can do this now? So how can you extrapolate all the values here, or like how do you create a matrix actually? Because that's a matrix, yeah, right? So what's the estimate a target share price at a 4.4% VAC and a 1% growth rate, 4.9% VAC and 1.25% growth rate, and 4% and 2% growth rate. So you can now start and calculate everything down by hand, or you can use the more convenient method and create a, how is it called? We'll see it later. Matrix out of it. You can see it later. So you go here to you have to first. Actually, all these numbers here. So this is linked, right? This is linked. This number should be hard plugged. So try to get a very good hard plugged number here. Otherwise, it will not work. It has to be hard plugged. This number should be also hard plugged. The rest is calculation, but it should be hard plugged. Then you plug in here this number here in the left upper side, and link this one to the middle, to your midpoint value again. Then you select this field and say what if analysis, data table. Row input cell is now, you link now directly to spec. The row is this one, right? This one. And our column is the 1.5%. So you link this directly because it links everything back to the model, and then it creates based on your assumptions and so on metrics out of it. If you would link this directly and not hard, this one here, you would have more, like it would count double amount and something. It would count more than it should. That's why it would not work. So here it works. So that's the sensitivity now. It's called table. Okay. Yeah. So it has this other brackets here. That's why. And how you can see that it's a matrix. So you can create a VEC growth rate sensitivity. You can create a revenue growth rate sensitivity. You can calculate the implied exit multiple actually. That's also what I would do as a sanity check. So let's call this section here. Let's call this sanity check. Let's call it sanity check. Sanity check. Because you can make completely wrong assumptions, completely off, and you wouldn't notice it because you were so deep into your business model that you've made so many assumptions that were not really correct. You always want to make as much checks as possible and to be able to justify it. So as a sanity check here, for the perpetuity growth method, we can calculate actually the implied exit multiple. So using the PGM method, what would be the implied exit multiple? So that's straightforward. It's the enterprise value divided by the EBIT in the final year, right? So the implied exit multiple here is 10.4. Our exit multiple was 14.3, so something is not good here. It should be now fairly good range. So 13 or something would have been fine. So that's not so good. That's actually the EBITDA multiple. Yeah. So it's fairly off. So implied growth rate, I will just copy this cross, is actually the terminal value times your WACC minus the final year unlevered free cash flow divided by the final year unlevered free cash flow plus the terminal value. So that's the implied growth rate. So you actually just have the terminal value per PGM formula and make the G here as unknown. Change the equation accordingly, and then you have the implied growth rate. But I'm not going to do this now because it takes a little bit too long time. So that's the terminal value times the free cash flow in the final year. Times the WACC minus the free cash flow in the final year divided by the free cash flow in the final year again plus terminal value. Let's see if this is correct. Yes, it gives them that. Yes, this is exactly what it should be. It should be 1.5%. Why? Because our growth rate is 1.5%, so the implied growth rate should be the same, right? If not, that was a big mistake. So PGM, let's see what's the growth rate, implied growth rate for EMM. It's 2.3%. So it's also way off. It's above the GDP growth or in line, almost with the ECB target GDP growth and inflation growth. So a little bit above. Not too bad, but above. Okay. So I hope this was clear now. And that's actually everything that I wanted to show you. We created a detailed scenario analysis assumption schedule here that you can change easily using the drop-down menu. Then we extrapolated every segment in terms of growth, every EBIT margin, every capex per segment, calculated all the way down to the free cash flow. We did a working capital schedule. We calculated the WACC using the weighted maturity according to the bonds, so the weighted cost of debt. Then we used the CAPM for the cost of equity. We used the market debt. We calculated market debt using this formula you can find on the internet. And calculated the WACC. And then we calculated two methodologies, the PGM and the EMM method, using once the WACC and the growth rate for perpetuity, and once the exit multiple for, as we say, that it can be sold after 5 years. Then we accounted for mid-year discounting because we assume that cash flows are going to be earned throughout the year, not just at the end of the year. So this would lead us a fairly different share price as well. Actually, it would be even a holy recommendation. So there's a big issue here. Always lots of sensitivities. As you can see, DCF is lots of sensitivities involved. That's what makes it so exciting, actually. Then we made a sensitivity analysis. You can make more and more if you how many you want. It's up to you. And that's actually your range of values then. Yeah, so 80 and 124 with mid-year discounting PGM. Right? So I hope this was some more understanding for you, and you could now start modeling by yourself. Use P group beta, and thank you very much. And enjoy modeling. And if you have any questions, any advices for improvement, I'm happy to hear it. Please write it into the comments. I hope it wasn't too long and too boring for you, and so on and so forth. Thank you, and see you.